Hola amigas y amigos, welcome back to the Greencards to Greenback Show. I am your host, Nestor Vargas. I'm going to help you find peaceful prosperity by sharing practical money tips and proven mindset hacks. I'm a certified financial planner with over 12 years of experience and a first-gen kid who now makes over 6 figures only working 3 months per year. If you're a Latino or Latina looking to dramatically improve your current situation, this is the show for you. In this show, you will hear real-world examples of what other successful people are doing to make more money and live a better life. Let's dive into the show. Welcome back to another episode of the Greencards to Greenbacks podcast. I am so excited you're here today because we're going to be talking about one of the things that I'm most passionate about, which is investing. We all know that wealthy people use the stock market to increase their wealth. But it's not that intuitive, right? It's not as easy as buying low and selling high. We need to know more about this topic. And in order to build a successful investment portfolio, you need to understand what different types of investments are out there, how to choose them, how to understand the cost within them, and make sure you're building a portfolio that is good with your risk profile that you feel comfortable with. And that also it's easy. So we're going to be building a foundation via this podcast today, a foundation that is going to be solid. So whether you already have built something accidentally and you don't know what you have, because that's a lot of people come to me and they're like, hey, I don't know what I've been doing. I just chose these things and looked at their performance and I don't even know what I have. So if that's you, we're going to be able to get you to a position where you'll feel more comfortable with what you have and making changes. And if you're just getting started, this is also great for you because you're going to be building a great foundation. And a simple foundation you can go ahead and get started with. All right. What is an investment portfolio? We're going to start there. An investment portfolio really is very simple. It's a mix of stocks, ownership of companies, a mix of bonds. So IOUs, we'll talk a little bit more about those in a minute, a mix of cash, and maybe a mix of real estate in there. That's what an investment portfolio is. We don't have to complicate it. Stocks, bonds, cash, real estate, a mixture of them. What is the right mixture? We're going to talk about that a little more in detail as we move forward. Now, what are the benefits of investing via the capital markets, stocks and bonds, cash? You can also actually buy real estate through the stock market as well. It's simple. It allows you to actually focus your time somewhere else. Unlike owning a business, unlike actually having direct ownership of real estate, buying stocks and bonds and cash and real estate through the stock market is a very hands-off approach if you do it correctly. And that's what we're going to talk about today. How to do it correctly, right? How to actually build an investment strategy where once you set it, you don't have to worry about it every day. You don't have to monitor. You don't have to do all the things every day. Now, you do have to monitor it every once in a while, but it is an ability for you to actually create wealth, have someone build wealth for you, right? Anytime you buy a stock, you're buying ownership in a corporation, and therefore you actually get employees that are making money for you. Right? Anytime you buy bonds, you're having that corporation figure out how they're going to create enough cash flow to pay you back the interest and your investment whenever that bond is up. So those are the benefits. It allows you to start building and create a roadmap to financial freedom in a very hands-off approach. So therefore, you can spend more time with your family, increasing your business, getting better at your career, right? So now one of the things that we're going to get into is now we're going to talk about how do we first figure out how much risk am I going to be taking and how much should I be taking? And this is really where I started looking at things very differently than the world looks at them, the investment world looks at them. And this is something that it took me probably about 11 or 12 years to actually figure out. And it's that volatility, okay? The amount of how much your portfolio goes up or down. That's called volatility, right? Like middle is where things are stable. You go up, that's a volatile. We went up, and volatility go down. Volatility is not risk. And I want to make sure this lands. Volatility is not risk as long as you're invested appropriately. Volatility is the price we have to pay as investors to get to financial freedom quicker, to get more return than what a bank is willing to pay us, okay? The true risk is this: you not growing your money fast enough and not being able to retire. The risk is you not being able to beat inflation. The risk is you having to work longer because you weren't very growth oriented. And so traditionally, the way that the personal finance space has come to helping people figure out how much risk they should be taking is that they have them take like a 5 or 10 questionnaire. It's called a risk questionnaire. And depending on how you answer those questions, there's a little thing happening in the background that converts your answers into a particular number. And so maybe you're like a 70, okay? And so all of a sudden now that risk questionnaire is telling you that you should have 70% in stocks. So 70% in gas pedal, stocks are at the gas pedal. They're what grows your portfolio. And then 30% in bonds, in your breaks. And I think that's erroneous. I think that's a really disservice to our community and disservice to investors. A better way to look at this is how much cash do I need, or how much stable investments do I need? And that's going to be somewhat of a personal answer, but it's also going to be more of a little bit of a mathematical equation. So I'm going to break this down for the two different groups that are probably listening to this. The first group is people who are working, okay? And so if you are working, the first thing that I want you to ask yourself is, are you and your spouse working? Because if you and your spouse are working, the risk of both of you losing your job at the same time is a lot less. So there's less risk. If you are the only breadwinner, you have a higher risk to your personal financial picture because, again, like if you lose your job, there's no more income, right? So from that perspective, if you're the only breadwinner, I would say 12 months. And I know it can take forever to get up to 12 months, but it's going to be vital to make sure that you don't screw up your investment strategy, that you feel comfortable with having really growth-oriented investments that bounce up and down quite often. If you are married, I would say 6 months is quite fine. I don't think you need more than 6 months. Now, if you are getting close to retirement or already retired, the way I look at it is how many years do we want to have in a war chest to be able to weather the recessions and the down markets that happen inevitably when you invest in these types of markets. I typically recommend at the very least 2 years worth of cash or bonds to cover your expenses. So if you have a $10,000 monthly expense, which is high in retirement, but that's fine, then you're going to be looking at about $240,000 of your portfolio being cash and bonds. If your expenses are less, then you don't have to have as much. The rest, though, is where we want to get our growth, right? Like that is what we're after at the end of the day, right? We want to make sure we continue to grow our portfolio so we can continue to take our trips, take care of our family. If you're younger, we can retire, right? So I wanted to start there because that is a really important question that you need to answer, whether you're already invested or you're going to get started investing, is make sure that you have a good war chest. I call it cash and bonds. That's a war chest. If we go to war, quote unquote, and the stock market starts going down, then we go into our war chest. We go into our bonds and cash. All right, good. Building that portfolio, make sure you have that emergency fund. Let's talk about common types of investments now, okay? I want to make sure we build a good foundation of understanding of what's out there, and then we're going to talk about how to build this thing. So you've been able to access stocks or bonds. They're packaged in 3 different ways. One is individual, right? Like an individual stock or an individual bond. And you can have more than one stock and you can have more than one bond in your portfolio. Remember, I said a portfolio is just a combination of stocks, bonds, cash, or real estate. The second vehicle that was very popular, still seems to be popular, but not as popular as before, is a mutual fund. Okay, so what's a mutual fund? Guys and girls, so let's not make this complicated. It's a bucket. It's not an investment. It's a bucket. A mutual fund holds things inside. So the attractiveness of a mutual fund is that you can buy one mutual fund, and that mutual fund can have hundreds, if not thousands, of securities, stocks, bonds, cash, and even real estate in it. So it allows you to spread the risk among many different companies without you actually having to own the individual companies and keep track of all of them. And so you get that diversification, and also you get the professional investment management on top of that, which is really beneficial for a lot of people. And then the third thing that is out there is something called exchange traded funds, ETFs. And basically what an ETF is, again, also just a bucket. It's not an investment type. It's just a vehicle. And then what you fill up that ETF with, meaning what that ETF has, is what dictates how much growth you're going to have, how much safety you're going to have, just like the mutual fund. The reason the ETF was invented is because it's something that you can actually trade in the stock market while the stock market's open. And so it allows people to be a little more tactical with their investments. And they actually now have lowered the cost of it. Unlike a mutual fund, when you buy a mutual fund, you're not buying it through the stock market. Although it holds stock market investments, you buy it through the company that has that mutual fund. And when you want to sell, you have to go to the mutual fund company, redeem your shares, they give you cash. You only are able to get the price at the end of the day. So with the mutual fund, when you buy a mutual fund, you get whatever price that mutual fund was worth at the end of the day. When you sell it, you get whatever price per share that mutual fund was worth at the day. Unlike an ETF, you can trade it immediately as long as the stock market's open and you get that price. So again, individual investments, mutual funds, ETFs, baskets of investment. And so now that we've talked about the common types of investments, let's really now talk about understanding the fees that go along with investments. Because this is a investing 101 class, I'm not going to get into like the weeds of it. I'm going to get into some of the most important fees that you should be aware of. And then in later classes and podcasts, we can definitely dive into the meat and potatoes. But what I'm going to give you is sufficient. It's sufficient for you to get started on building wealth or optimizing the wealth that you already have in the stock bond market. When you invest in stocks, the main cost that you're going to incur is buying or selling that individual stock. Now, the amazing thing that's happened recently is that a lot of this discount brokerage firms are the companies that actually specialize in giving you the capability to buy or sell stocks, are now allowing you to buy stocks at there's basically zero. And so companies like Fidelity Investments, Charles Schwab, Vanguard, TD Ameritrade, they are allowing you to buy the stocks at zero, right? Zero transaction cost. So be really careful when you're working with someone and they're charging you high commissions just to buy stock. That's not necessary anymore. That's not necessary anymore. In my opinion, if you're the one choosing the stocks. Now, if someone is providing the service and telling you what to buy, then there's merit. I'm not a big individual stock or bond purchaser. I've been doing this for 15 years. As of the recording of this podcast, I manage over $8 million worth of assets, and I don't see the need to have individual securities. All right. Now let's move on to mutual funds. Okay. Mutual funds typically will have two different types of expenses incurred with them. There is a mutual fund trading fee to buy the mutual fund and sell the mutual fund. Some mutual funds don't have any cost. The most I see typically out there, the cost is like anywhere $25 to $50 a mutual fund. Right. And you have to be careful also where you're buying these mutual funds, because let's say you're trying to buy a Vanguard fund, a Fidelity. Fidelity doesn't really love the Vanguard funds on their platform because Vanguard doesn't share any of the revenue with them. So they're going to hit you with maybe a $75 or $100 fee to buy that mutual fund when you can just get it for free if you go to Vanguard. So you have to just first figure out kind of what your investment style is going to be, and then figure out which company you're going to use to have to pay the least amount of cost there. The second expense with mutual funds is the expense ratio. So that's the internal expense of the investment, and that pays for the fund manager, it pays for the trading, it pays for all the paperwork that needs to be created and sent to you, because you're now an investor of basically a company. You own an investment company. And so there's an expense ratio there. Thankfully, those expense ratios have been going down quite a lot. I personally would shy away from anything that is more than 1%. I think 1% is even pretty high, but anything that's more than 1%, I would probably not go that route. ETFs, very similar to mutual funds, have a trading cost. Thankfully, because they act like stocks, most ETFs don't have a trading cost anymore of some of the major brokerage firms. And the expense ratio is, again, the internal expense of the mutual fund. By the way, you don't pay this out of your pocket. It's just the expense ratio is taken out of the fund automatically every day before you actually know how much you made that day or lost that day. That expense ratio is already taken out, but you can always take a look at its expense ratio, and that can be found pretty much anywhere. Morningstar is a great place to go look at it. Morningstar.com. Yahoo.com is actually a pretty decent place as well. Yahoo.com has a lot of historical data, so I really like being able to dive into historical data a little more as well. So those are the expenses. And then the other expenses, if you're working with a professional to help you build a portfolio, they're going to charge you a fee for that. Now, I'm going to say this, and I also want to make sure this lands, is that if you are paying an advisor just to manage your money, you fire him or her. Okay. So if you're paying a financial advisor a fee just to manage your money, and that financial advisor is not providing any other type of services like financial planning, insurance planning, tax planning, other services, fire that person and go get someone that actually is going to give you a value for what they're charging you. Right. Again, those are the expenses that are entailed high level in terms of investing. Alrighty. So now how do we choose? How do we choose the investments? Because as you probably are asking, okay, great. Like now I know mutual funds, I know expense ratios, I know ETFs, I know stocks, bonds, I know real estate, I know cash. I know maybe how to even think about how much bonds versus stocks I should have because we talked about the war chest. How do I do this? All right. Again, we're going to make this simple, guys. First decision you're going to want to make is, do you have the time, the will, and the skill? Time, will, and skill to develop your own investment strategy. If you do, companies like Fidelity, Vanguard, Charles Schwab have plenty of resources. When you log into their website, just type in, how do I build a portfolio? And they're going to walk you through it. Okay? So you can be really hands-on where you're picking your own investment. And if you're just getting started, and frankly, if you've already been investing for a while, using really broad investments like index investments is probably really the way to go, frankly. And I say that for someone as me. Again, I've been doing this for 15 years. I manage over $8 million since the recording of this podcast. I'm a certified financial planner. I've got a finance degree. Trust me when I tell you. In picking individual stocks, not very many people are good at it. Okay? Do you have the time, will, or skill? If you do, then again, go do your homework, figure it out. There's plenty of resources in this major brokerage firms, like I told you, Fidelity, Vanguard, Charles Schwab. Great places to get started. Maybe you want some type of help, but you're not really ready to work with a full-on financial planner. The great thing is there's something called robo-advisors, R-O-B-O, robo-advisors. Basically, it's a computer model that will walk you through a risk questionnaire, which you guys know I don't like, but you're able to choose whatever stock to bond ratio you want. And then that computer model is managing your portfolio. It's taking the basics of investing and doing them for you. And then the third option is, you know what? I actually do want to work with a professional. I want that person to know me, my spouse, I want them to know my situation, and I want them to build a holistic approach. I want them to make sure that they're taking into consideration how my 401k at work is invested, how I want to invest for my kiddos, my taxes, social security income in the future, my business income. Then you find a financial advisor. A great way to find a financial advisor is to go to napfa.com, NAPFA.com. Make sure you listen to my podcast episode where I talk about how to choose a financial advisor as well. There's a lot of great stuff there. If you do end up wanting to go that route, go listen to a podcast episode. It's only about 15 minutes, and I think you'll learn a bunch. Alrighty, those are the topics, right? Like we talked about the basics of investing. We talked about how to define risk and how to turn that upside down and actually be smarter about how you view volatility. Remember, volatility is a price you have to pay in order to get more return and get to financial freedom quicker. And remember, volatility is not risk as long as you're invested appropriately. If you're just invested in one or two stocks or you're betting in the market, the volatility is going to be a big deal for you. That's going to be a risk. But if you are invested appropriately, volatility is just the price we have to pay them. Okay? Make sure also, guys, that you invest regularly. I can't tell you how many times I see people really want to put money in the market when it's doing really well. And when it's doing bad, no more investing. You're doing it completely wrong if you're doing that. You want to make sure you're investing when the market is down because that's when things are on sale, right? So make sure that you view it in that way. Things are on sale. If you're going to buy a solid investment, then you should feel really comfortable in buying things when they're on sale. So I hope this has been helpful. I want to leave you with a couple of action items. One, figure out what your stock to bond ratio should be. I gave you the tool at the beginning of this podcast. Two, figure out which way you're going to invest. Are you going to be individual index investor? Are you going to use a robo advisor? Or you use a financial advisor? And get started today. Do not wait. Make sure you start creating that wealth and make sure that you don't procrastinate. I hope this has been helpful. I'll see you guys later. Let's go make those greenbacks. Bueno, pues. I hope you guys enjoyed this episode. I want to go ahead and ask you to please send me any questions you may have or any topics you want me to talk about. Go ahead and send them to Nestor, Nestor, at greencardstogreenbacks.com. I actually read every email you send, so I'd love to hear from you. Don't forget to head over to greencardstogreenbacks.com for the show notes for this episode and really links to any resources we may have discussed. Bueno, amigos y amigas, nos vemos pronto. Let's go make those greenbacks.